All right, so the first thing we're gonna do is I'm gonna kind of refresh with my people, and I'm gonna tell you what each time frame is and what each time frame is used for. We only use 4 time frames. So the first time frame that we use is the D1. The D1 is used for direction. The second time frame is the H4. The H4 time frame is used for momentum. Then we use the H1 to find our take profit and stop loss. And finally, the M15 or the 15-minute chart is used for our entries. So the way that you set these time frames up is you want to find the immediate high and low on each time frame that we just pointed out here. Now this is generally what you call a setup. Setups are usually set up on either a Monday or a Sunday, and you use this for your trade week. Now, what you want to do is you want to find out where each one of these indexes are currently at before we even start our setup. So our dominant pair is the US dollar index. You can use investing.com or you can use TradingView. We'll use TradingView. That's the site that we're on now. It's called TradingView. We'll use TradingView to identify where these indexes currently are.
Dad, did you try my tablet?
So before we get started on the setup, what I'm going to do is I'm going to check each one of these indexes on tradingview.com. Let me show you let me take this screen off here so you can see my full screen. And you know what? No, I'm not. Hold on, I'm going to type in DXY in TradingView. So I'm typing DXY into the search and nothing to pop up at the bottom. You got to make sure you click enter when you type in DXY. This is going to show you the dollar index. Now, how the dollar index works and how currency trading works is generally if you got USD JPY, it's the US dollar versus the Japanese yen. So if you're going to figure out which one is stronger or weaker, you got to first see where the index is, correct? So without seeing or checking the indexes on each one of these currency pairs, you're not doing yourself any justice, because at that point you're just relying solely on technical analysis. So looking at the DXY, always on the daily chart, you can see that the dollar index is down. The US dollar is weak. So if you look right up here in the top corner, it tells you the price, 91.35, and it's 21%, 0.21% below the price level. Anytime any index is above or below 10%, that's the true trend. So that's the true trend for that specific currency pair. So you wouldn't want to be buying a USDJPY knowing that the dollar index is down. And you can clearly see the momentum because like I told you in the beginning, we use the daily chart for what? For direction. So if we're using the daily chart for direction, we got to figure out where that index currently stands. So that we know that the dollar index is short, 91.34 is the price. So what I'm gonna do, now is I'm gonna go back to my US dollar chart or USDJPY chart. I'm gonna double click on the text bar. Come on. Oh man. What the hell just happened? I don't know what the hell just happened. Okay, I don't know why it just deleted stuff. Whatever though. Anyway, so what I'm gonna do is I gotta identify or write down where that dollar index is. Because like I said, the currency pairs work as so. USD versus the Japanese yen. Therefore, we got to know where both of these currencies individually stand. If you're not knowing where they individually stand, you're not really doing proper technical analysis. You just kind of freehanding it without actual data to back it. So the US dollar index is currently at 91.36 and it's above our 10% true trend level. It's at 19% now. That being said, next we're going to look up the Japanese index. So DXY is the US dollar index and JXY is the Japanese yen index. So DXY. Now all I'm going to do from here is I'm going to type in JXY into TradingView to figure out exactly where that index is, if it's bullish or bearish. But for now, we know the US dollar index is bearish. Type in JXY. And as you can see, the Japanese yen currency index pops up. Click on interactive chart. Looking at the daily chart of the Japanese yen index, you can clearly see that it's bullish. So we know that our setup should be getting set up for short until facts speak otherwise. So what a lot of people get confused with is they automatically think that the market is too low and they get out too early. As long as your index is still indicating that it's still a strong buy or a strong sell on each individual index, it's going to continue to respect that trend. I don't care if the market went down to 106.33, 106.333. None of that matters. None of that matters at all. You got to pay attention to what the index is telling you because you can easily get tricked without knowing these facts. So we got the Japanese yen index is currently at 92.8. It's up 0.59%. So that's another trade that's up, that has a true trend that is following, and it's bullish. So now what we'll do is start our setup. The D1 lets us know the direction again. The H4 tells us momentum. The H1 is where we find our take profit and stop loss. Everybody should be taking notes. The M15 is letting us know where our entries are. Now, when we set up these charts, all we're doing is looking for the immediate high and immediate low of each one of these time frames that I just identified for you. That's all we need. We don't need 16 highs and 16 lows. None of that is going to be relevant because the market trades within a range. Mute your mic, mute your mic. So the market trades within a range, immediate high and lows on each time frame. Each time frame, each smaller time frame, I want to say, it's going to show you the fluctuation of price, where the price is fluctuating. So what we done with the indexes is we came up with a bias. Our bias is that the market is still going short, so it's still a sell. It's not prepared to be a buy yet until the indexes indicate such things. Right now, you can clearly look at these indexes, and I don't even have to click on the charts. You can watch the numbers at the top here, and you can see it's going down even further. It's at 22%. This is going up even further. It's at 62%. That's the reason why we mark the numbers down. I don't care how smart you are or any of that. If you're not keeping track of these numbers in these key areas, you're not doing yourself any favors. So you got to make sure that you pay attention to that. Now, when I talk about immediate highs and immediate lows, I'm speaking in reference to this area that you can immediately see. Everybody want to pay too much attention to the past is why you lose too much money. You can't focus on the past yet if the market is trading within a range. If you're trading within the high and the low range of the daily chart, that's the only range that you want to be paying attention to. Anything else is completely irrelevant at the time. So the first thing I want to do, if you're not sure on where the high and the low is for that chart, simply just go down or simply just zoom in and it'll give you the relevant, give you all the relevant areas that you need to pay attention to. And see, it hid everything else. Don't get confused by everything else. Now with the daily chart, we use burgundy lines, not burgundy dotted lines. We use burgundy solid lines like that. If you want to know how to change your color, the moment that you drop the line, just double click on it and you change the color here. The burgundy line is the daily chart. The red line is the 4-hour chart. The hour chart is orange. 15-minute is yellow. All of our 38.2 Fibonacci retracement zones are pink and dotted. So every time you see me post a chart, they pretty much look the same. They pretty much have the same colors and everything like that. This is to distinguish each one of those specific zones, the support and resistance areas. Now you can see the market has already fell below our daily low. Now, this is where a lot of people get confused at, is because they think that the market is too low, so it has to rally back. There's no need for it to rally back until these indexes indicate so, because this is U.S. dollar versus the Japanese yen. U.S. dollar versus Japanese yen, you're simply saying that the dollar is stronger or weaker than the Japanese yen. Right now, the dollar is weaker than the Japanese yen, so we sell it. There's no other indications that you got to be worried about. Your indicator might tell you to buy now. You might have the analogy of buy low, sell high. But if your indexes do not indicate that there is a bullish momentum arising because of the fluctuation of price or switch, and you get a bullish once you get a bullish dollar and you get a bearish Japanese yen, then you start buying. But in the meantime, all those rallies, small rallies to the upside, are just fluctuation of price. So don't ever think and rely just solely on your technical analysis, because that is bull. That's bull. It's all based off of index. It's all based off of one versus the other. And when you buy and sell, you're saying the dominant pair, so the first pair, is stronger or weaker than the opposite pair, than the non-dominant pair. So that's what you got to realize and to begin with. You have to always check the indexes, because if you're not, you're just trading in the dark. At the end of the day, technicals don't always support fundamentals, and if technicals don't support fundamentals, you'll see flat movement. If technicals don't support microeconomics and macroeconomics, which is what moves these indexes, you'll see flat movement. You'll see fluctuation of price. There's no true equilibrium when it comes to trading. And if there's no true equilibrium when it comes to trading, it's all based off of a fluctuation of price. So what you have to do is learn to find where the price stabilizes at, where the fluctuation of price is stabilized at. You can't do that if you don't know what direction the market is going in and how to properly set up your charts the right way. So that's what this webinar is strictly for. It's strictly to show you how to properly set up your charts so you don't get fooled. We do the same thing on this chart. We identified the highest high and identify the lowest low. I'm going to change the color. Here, let me move this up because a lot of yours will be up here. So here's the highest high, and here's the lowest low on this time frame. Once we got that marked, next chart we go to is the hour chart. We do the same exact thing. Change the color to orange now. Oh, this one's supposed to be red. That's the highest high of this time frame currently. So that's orange. This is the hour chart. Find the lowest low. Here's the lowest low of this time frame. That's orange as well. Finally, down to the 15-minute chart. Fifteen-minute chart is yellow. High is there. Low is just a little bit below it. Now, what we're going to do is we're going to go back up to the daily chart so that you can see where the market is trading within. It's trading within that high. It broke the low already. It broke the daily low. I'm going to make these dotted so you can see that underneath there is the daily low. That's the burgundy line. So currently on the 15-minute chart, the highest high is theoretically at the lowest low on the highest high on the 15-minute chart is currently standing at the lowest low on the daily chart. So what we want to do, so now we start our fibs. If the market is going down, your fibs go from swing high to swing low. So looking at the immediate time frame here, the market is pushing down. So our fibs go from that swing high to that swing low. We only draw fibs on the daily chart, the hour chart, and the 15-minute chart. We never draw fibs on the 4-hour time frame because it's already given us momentum. Right now, what we're looking for is where price stabilized at. 38.2 zone is where price fluctuation stabilizes. So you'll have a better entry within that area. If the market gives you 3 consecutive candlesticks below the 38.2, it's indicating a sell. If the market gives you 3 consecutive candlesticks above the 38.2, it indicates a buy on either one of those time frames. So now I can delete the 38.2 zone because it's too much on the chart. Only thing I need is that pink dotted line that indicates what zone that's in. Now, what I'm going to do is I'm going to draw a 38.2 fib on the hour chart now. I'm staying within that zone, within the time frame that I'm on. So if I'm in the hour chart, which is orange, that's the orange support resistance area, I'm gonna go only to the orange support area. And I'm gonna draw my fib from that swing high to that swing low. Click 38.2 level, delete the fib. Again, same concept. 3 consecutive candlesticks below the 38.2 level indicates a sell. 3 consecutive candlesticks above the 38.2 level indicates a buy. Always wait for a retest. Once you get a retest in that zone, it indicates that it's a good entry. It's a solid entry. So when the market comes down and touches it once, that's not good enough. Twice, that's good. That's why we wait for that third candlestick to form. And we wait for the market to retest that area one more time before we enter. On that third candlestick, when it forms, you will see either a pullback back to that area, and they indicate that it's time and it's good enough chance for you to be right, to be in that sell. The last time frame that we draw our fibs on is the 15-minute chart. Now, looking at the 15-minute chart, the immediate high and immediate low, we can see that our fibs got to go from swing high to swing low now. Or swing low to swing high, I apologize. Just as so, 38.2 level. Now, this is why we check the indexes first, so that we can clearly see where the indexes are and what price is currently about to do. You see how we tested once in this area. So this is why we always wait for a retest. And this is why we always check the DXY and the JXY first, or that specific currency pairs index. That way we don't get faked out. Now it looks as though, you would get that bullish rally because we're three consecutive above. But as you can see, we're below the daily support. And we're also and we got two ranges of resistance in that area now. We got not only the 15-minute resistance, but the daily resistance, which is the strongest resistance within the market. Now, let's say that the market did come above and it closed above that area. Then it'll indicate for us that, based off technical analysis, that it was strong enough momentum. But the fact that we knew it's not strong enough momentum is because of our indexes. Each individual index is going in a way for a sell. We got the DXY, or the US dollar index, that is short, or that's weak. Then we got the JXY. That index is strong. So it's still a sell. It's still indicating a sell, regardless of how low the market is, how low you think it is. Those are all psychological levels. Psychological levels cause you to do things that you really shouldn't. Now, based off of what we have here, our indexes, we know that we still got to prepare for a short. Now, this is the first test. As you can see, this was the first test to the 38.2 zone. This is the second test now. Once we come below here with three consecutive candlesticks, it's strong enough for us to sell it. Now, the people who caught this here and saw the general move, you got to pay attention to the support and resistance areas. You can see the support, or you can see the resistance from the daily chart. You can see the resistance from the 15-minute chart. This is why we do our setups after we find the indexes, because we don't want to get in the fake out. We don't want to get faked out of the trend, faked out of the direction, not realizing that the direction is still bearish, is not bullish yet. So we're looking for short entries. We're not looking for buys unless indicated otherwise. Once our indexes begin to revert and start to switch back, then okay. Now what we do is we react. We react at three consecutive candlesticks within this zone based off of the momentum, based off of the price fluctuation stabilization that occurs at the 38.2 zone. Since we on a smaller time frame, you see mad price fluctuation. So it seems like it should begin to pull up and be a rally. But right now, we still got indexes that's saying otherwise. Indexes are stronger than just your technical support. This is what's moving the economy. This is what makes the world go round. So we have to make sure we really pay attention to what's currently going on. Now, with the 15-minute chart, once we found the 38.2 zone, I can delete this. This is where we're looking to enter at. We have to wait until we got to wait until we close below it though. Once we begin to close below that, you'll see more momentum shift. You'll see that it'll at least go back down to this area here. So this is where we use our risk to reward ratios, in which I'm going to get into now. But first, let's identify the entry. There's always an entry on a chart. And no matter how high or how low those areas are, it's always an opportunity for another entry. So at 107,740, so 107,740. Now this is why entries is so important for you to find. Because let's say we get news, let's say anything occurs that it causes price to shift, and we see these indexes begin to shift in the opposite directions of each other, then we know that we can still enter our buy within this area as well. If we get it too late and we see it too late, we can enter our buy within this area as well. So these multiple 38.2 zones act as your entries, act as potential areas to where you'll have a better chance of being right, better chance of making money. So what I want to do is, if I come over to the left here, I can set an alert. Click on add alert. I just added alert. So now TradingView will send me an alert and lets me know. It sends me an email and it also rings on my computer, lets me know when the market gets to that area. So now I can start to think about what I want to do, my reaction from there, that point on. And if you look at here, if you just take the simple concept of 3 consecutive candlesticks above or below after the first retest, 1, 2, 3, close below it. The market continued to fall down. So theoretically, that trade was a winning trade. Now I'm gonna show you that trade and how it would have played out using your risk management as well. But first, let's talk about some risk management. Okay, so risk management is the keys to trading. Risk management works as so. We only risk 10% of our entire account on one single trade day. So at risking 10% of our entire account on one trade day, if we risk 1% on one single trade, that's 10 different opportunities that we'll get to take beyond within that trade day. Now, understanding risk to reward ratio, a risk to reward ratio is simple as this. We risk one to make three. That's how we get our take profit and that's how we get our stop loss. Risk to reward ratio on every single trade is 1 to 3. So if I'm risking one, let's say you started off and you tested the market with a 0.1. Once you get negative 10 pips, negative $1, then that trade is you were wrong that time. But you got another opportunity. You got another chance of testing the market out again. Now, there's a key factor to that. Let's say you got to start it off with $100 account. Your total risk that you can risk for that entire day is $10. At a 0.01 lot size, that's a risk of 10 pips. That's 1%, negative $1 that you will lose. Let's say you lost 5 out of those trades. That's 5%. You still got $5 that, or 5 more percent that you can trade with, 5 more dollars that you can risk. With that being said, the rule of thumb here is you lose 5 trades, you were absolutely wrong, and you're going in the wrong direction, so follow the trend. Now, if you lose those 5 trades and you were absolutely wrong, that's 50 pips at the end of the day. But you've only risked $5 using good risk management and using good risk to reward ratios. So what this allows you to do, those next 5 trades that you take just based off of compounding and based off of you actually following the trend from that point, you will at least win 3 out of those 5 new trades. Now, if you run 3 trades out of the last 5 that you can trade, you've brought your account up 15% because you're winning $3 on every trade or 3% on every trade. So 369, or you made around 15%, $9 or 9% actually, 9% gain and $9 profit on that single trade. Now, what that'll do for you is that create something called a reserve capital. Now, let's say you won 5 out of the 5 trades. Was more than likely if you were going the wrong way and you start to kind of reanalyze the situation, follow your setup accordingly. If you follow your setup accordingly, you'll at least win 5 trades out of 10. Winning 5 trades out of 10 brings your account up to 15% gain, plus the original 5% that you had left to trade with. That's a total of a 20% gain, 20% gain, and 20% in your reserve capital. So for the next day, your account will be at $115, give or take. Now, a 10% loss for that entire day. Let's say the following day you didn't do so good. That 5 trades that you did win on that day, it kind of protected you for the following day. So every day that you at least win 5 trades out of 10, it's protecting you for the next day. So let's say you had a bad day. You lost the entire 10% that you were able to trade with. Theoretically, that'd be $11.50. your account balance is still being positive, $103.50. So at no case at all should you ever blow an account out if you're applying good risk management and using risk to reward ratios. Now, what you want to realize is if you're risking 10% for an entire trade day, you want to approximately make around 40% gain if it's possible, or 40% gain for that entire trade week. So for the entire trade week, you should at least see a 40% gain. If you see a 40% gain for that entire week, that brings you up to where you need to be. It's always going to give you that reserve capital that constantly builds over time. So the trading plan that I provided with you or for you is going to prevent you from losing money because you're testing the market out first with a zero point 0.1 lot size. It's telling you catch 13 pips, then catch 34 pips, and it's bringing your account up to a sustainable balance to where you can't really lose that entire account or you can't really lose the reserve capital. It's protecting you. So just think about it like this. Even if you had a shitty 10 days, first day you risk $10, next day you risk 9, 8, 7, 6, 5, 4, 3, 2, and 1 finally. Now what that enables you to do is you'll still have about $45 left that you can still trade with following the next 10 days. Now if you're losing 20 days in a row, 30 days in a row, then that just means that you're not ready to go live yet. You got to take it back a step. Go back to demo account, go back to doing it. Because out of 10, you shouldn't be losing more than 10 days, more than 10 days in a row. Using good risk management, using a good setup, understanding risk to reward ratios. These things is what gives you an edge over most other traders. It's because they don't realize that how important these concepts are. So now let's talk about a take profit. Let's talk about how you find your take profit. Like I said, the take profit is always done on the hour chart. Now, if the take profit is done on the hour chart, and we know based off of our indexes, based off of our setups, we found a good entry, we'll go right over here to the left. Right over here to the left, you see something, it looks kind of like this. You see a long and short position ratio, long and short position. You want to click short position if you're selling, long position if you're buying. Literally click on it. It'll give you a take profit. In the middle here, it's showing you risk to reward ratio. It's going to automatically calculate your risk to your reward ratio. You want to move this stop loss level all the way down until you see 3-to-1. Once you get 3-to-1 or close to it, that's where your stop loss should be placed. Take profit, leave it there the same. And it's going to be something like this. I click this little dot. Oh. I click this dot, drag and pull down. As you can see, the risk to reward ratio is changing now. And I want 3-to-1, but I got 3-1-2. That's good. Now you got your stop loss set. You got your take profit set. You got everything you need for this trade. It's not giving you some trade that you're trying to aim for 100 pips without all these high numbers. It's giving you real accuracy. It's giving you real accuracy to the T. It's showing you that if you risk, let's see how many pips it's got us risking. We're risking 13 pips to make 41 pips. So it's giving us a good edge over being wrong and being right. Now, as being wrong, we got to calculate the fact that, okay, if I'm risking 13 pips, let's just say theoretically you got a $130 account, so you can risk around $13 in general. That's just enough for you to be able to enter this trade using good risk management. If you got a $50 account, you can't aim for too much. You'll have to bring your risk down, bring your take profit up, bring your risk down. That way you can make it so that you risk only 1% of your entire account on that single trade. You always want to make sure that it's 1%. So that's how you move and change that based off your account balance. If you can only risk 10 pips, then you would have to move your take profit up a little bit. That way you can move your stop loss down a little bit. That way you get your risk to reward ratio to always stay at 3-1, and it's going to protect you from losing more than you win. So once we got all our things set up, we got our call alert set up. The alert is going to let us know when we're in this zone so that we can react. We got our take profit found, our stop loss found. All these things is what's important when it comes to trading. You got to figure out, you got to take these steps and realize that if you take the proper steps, you'll get what you want every time. But if you're not taking the proper steps and going through the proper procedure, you won't get it. It's just like anything. But this is compounding. This is how you compound over time. This is how you build your account up. This is how you protect your account. All right, so now what I'm gonna kind of show y'all is show you how to trade on the bounces. Now, I'm not going to get into too much detail on this one because this concept takes a lot more time to get. But first, you have to learn how to properly set up your charts. That way, you can learn to trade on the bounces and understand what zone that the market is in, how the market is bouncing off the peaks and the valleys, how each peak and valley is represented, and how to identify the peaks and the valleys. But first, what I'm going to do is I'm going to just show you how to draw through the peaks and the valleys, and then during one-on-one sessions, that's what we go over. We'll go over how to properly set up those peaks and valleys, how to find them. So what I'm doing on my peaks and valleys, I'm coming from that highest high to the lowest low on our time frame. Here's the peak. Here's the peak. Here's the first peak. So the first trend line always comes from one peak. That's cool. The first trend line always going to come from the one peak to the next peak and all the way back down to the bottom. Everybody should have been on this joint, but that just lets you know who's serious and who not. Um, then what I'm gonna do is I'm gonna come from the top peak and I'm gonna come down through the valley. So here's the valley here. This is the valley. It always looks like a V. Then here's also a valley, two valleys in one. Then at the bottom there's another valley. Last but not least, start from the peak again. Come straight through the valley. Line graphs is used that way you can clearly see the peaks and the valleys. Anything that kind of looks like a V is a valley. So it went through two valleys. Through the first or the second and the third line has to always go through at least one or at least two valleys at minimum. The first line doesn't go through any valleys. It has to hit at least two peaks at minimum before it goes down to the final leg, creates that final range. Now, if the market is moving down, this is channel one. This is channel two. This is channel three or zone three. And this is zone four. So zone one is always the beginning of the trend. Zone two is the confirmation. Zone 3 is the continuation. And zone 4 is the end. Now, the reason why line graphs is a lot better, well, I'm not even going to say it's a lot better. The reason why line graphs work a lot easier is because whenever you see a valley like a V, it indicates a sell. Whenever you see a peak, it indicates the beginning of a buy. So if this trend line is facing straight up, that's an indication for a buy. Once the trend line creates a V shape, that's the indication for a sell or a continuance. Once you get that V shape or that line pointed up in the third channel, the continuation channel, that's letting you know that the market will continue to the downside or continue to the upside. So it's a lot easier to read line graphs once you understand the peaks and the valleys. So this is something that's always good to have in your arsenal, is to be able to read the line graph. The line graph works off peaks and valleys. V shape is a valley and indicates sales. So you can always see the beginning. It'll start up here and it'll continue down. Peaks indicates buys until a valley is created. Once that line starts to curve to the downside, that's letting you know it's starting a valley. Once the line points up to the upside, it's letting you know that it's starting a peak. You buy peaks and you sell valleys. So that's understanding how to read the line graph, how the line graph moves. Now each one of these things is important. You got the beginning starting here. It confirmed in here. It continued up here. Once it created a valley, it came back down. It fell into the channel of the confirmation zone, so it confirmed the downtrend. It kept confirming the downtrend. It was in the valley again in the third channel, third zone, continuation zone, confirmed it again. And this is why the market falls the way it does. This is how you understand what happens. Then if you look here at the end, this was the beginning of a short uptrend. It continued up, confirmed up. It started in the beginning, confirmed, came into the continuation channel, but it created a valley. Then it dropped back down to the confirmation of that valley. It dropped into the confirmation channel. It confirmed the sell, confirmed the valley. Came up a little bit more, made another valley. The valley was already confirmed. So this is where we currently are. The valley is still confirmed, is the reason why that we see the continuation to the upside using those indexes.